Okay, viewers, for the better part of the second half of 2022, viewers of financial news and readers of internet financial newsletters were bombarded with a constant negative message supposedly backed up by an ominous chart of the S&P 500. The negative messaging was the coming collapse of the US stock market in the fourth quarter of 2022 or the first quarter of 2023. This is even though the S&P 500 had already dropped over minus 27.5% peak to trough in nominal terms, minus 35% in real terms from its early 2022 peak. These declines were in line with the average bear market, the average recession decline for stocks, and the normal midterm second-year presidential decline. Nonetheless, purveyors of doom wearing black turtlenecks were grabbing headlines virtually every day on CNBC, Fox News, Bloomberg TV, and virtually every subscription newsletter I was forwarded. Here's one of many 2008 versus 2022 overlays. They were making the rounds in the third quarter of 2022. Mott Capital circulated this one. If you looked at the chart, you'd think Mott Capital was running money for clients and investing in this strategy. Alas, some quick research shows that Mott Capital is another newsletter subscription seller, not a fiduciary investment manager. This chart and other similar ones were everywhere, so much so that Jim Cramer even did a Mad Money piece on the subject in August of 2022. I said it back then multiple times, almost fighting with a few friends over the supposed overlay. This was not a real correlation, comparison, or overlay. The purveyors of this story conveniently adjusted the time axis to make this time series look legit. The S&P 500 essentially peaked in mid-July 2008. The S&P 500's all-time closing high in this cycle was January 3rd, 2023, almost 10% higher than its mid-July 2022 highs. This is not when or how the top and front of the great financial crisis looked. I do not know if Mott Capital has updated this overlay or publicly said, never mind, we were wrong, but I imagine the answer is no. While things might rhyme a lot in the financial markets, things are never exactly the same. However, historically speaking, there are data sets using more than one time frame that have happened multiple times across history that can be combined with rational thinking and an investment process. The purveyors of doom and negative time series, legitimate or not, get lots of airtime in the media because selling fear almost always works. Promoting death crosses, which historically have been poor indicators, or comparisons to the Great Depression or Great Financial Crisis, it's great for selling subscription newsletter memberships or getting airtime on stages. Meanwhile, those discussing historically positive investment dynamics get very little airtime. I'm here this week to discuss the historical importance and rarity of what transpired on February 2nd, 2023 in the S&P 500. That was a golden cross. I'm Chris Parris with Oak Harvest Financial Group in Houston, Texas, and welcome to our weekly Stock Talk podcast, keeping you connected to your money. This week's topic, technically speaking, the S&P 500 achieves a golden cross on February 2nd. And historically, that's a good thing. Before I get going, please take a moment to click on the subscribe button and click on the notification bell so you'll be alerted when our team uploads our latest content. Our investment material has a new place on the Oak Harvest YouTube channel as a separate sub-channel, and we now also have a totally separate channel titled Stock Talk with Chris Parris. Okay, viewers, what's a golden cross in the stock market? Well, this occurs when the 50-day moving average moves above the 200-day moving average. As the name suggests, historically, this is a good thing and a bullish technical signal for future returns. As always, there are no guarantees in the stock market. Most of the data we'll be referencing comes from the wonderful work of Steve Suttmeyer, Chief Technical Strategist at Merrill Lynch. Here's a chart of the S&P 500 with the golden cross on February 2nd highlighted by the shaded circle. The golden cross triggered on February 2nd was only the 49th occurrence over the last 95 years, since 1928. Historically, returns after a golden cross are stronger than average returns over 30, 65, and 195 days, 75% of the time. The 195-day return, a little over 3/4 of a year, has averaged about 10.75% the prior 48 occurrences. Even more interesting is the higher than average 195-day return when the 200-day moving average is declining as it is now. When the previous year's returns were worse, like 2022, that's happened 19 times in the past, and the average return over the next 3+ quarters averaged a little over 13%. What's truly interesting to me is how the indicator has had its highest success rate and highest potential returns when the news is the worst, when the economy is in a recession, when investors are despondent on the economy and stocks. This indicator has really earned its name as a golden cross. By traditional measures, we had a recession in the first half of 2022 with 2 consecutive negative real GDP quarters and 2 quarters of real economic contraction. No, the government body that puts its stamp of approval on this, the NBER, didn't say we have one, but the stock markets acted like we had one throughout the first half of 2022. We'll stick with the NBER recession definitions for this video because that's what Merrill's data tracked. Over the last 95 years, the NBER has declared 15 recessions. The S&P 500 has generated 14 golden crosses during 13 of these 15 recessions. The 1929 through 1933 recession had 2 golden crosses per Suppmeyer's work. Almost 93% of the time, which is an extremely high hit rate, over the next 195 days, the S&P 500 returned 22% on average. This was also the median return, so the data was very tight. Here's the Merrill Lynch summary data for these types of time periods. We've attached the raw data at the end of this presentation for those who want to see the nitty-gritty and maybe compare the current period to your favorite recessionary period. What should also be interesting to investors is that, as Jeff DeGraff of Renmac points out, the S&P 500 has historically provided investors with a higher Sharpe ratio or risk-adjusted return during periods with a positive golden cross. This means that historically, the upward ride during these periods is usually less volatile and smoother for investors, and that investors receive higher returns per unit of risk as measured by volatility. That, of course, would be a great thing for investor anxiety. Just check out Jeff's work that shows the 2 distribution curves for risk-adjusted return. The shift in the Sharpe ratio, curve to the right, shows the decrease in return volatility and increase in the Sharpe ratio. It's just a mean, of course. There are no guarantees, but this too would say the next 3 quarters should be looking up, not down for investors. Viewers, historically, we remain in the best part of the presidential cycle for investment returns. That is, from late 3rd quarter of year 2, which was 2022, through year 3 of the cycle, which is 2023. This, combined with the above data about the golden cross and hedge fund positioning heading into 2023, could continue to provide a tailwind for the markets into the mid-2nd quarter before being subject to the usual summer market slowdown. If the ongoing market volatility is making you feel uneasy, give us a call and schedule a meeting with an Oak Harvest advisor. Our team has multiple market and insurance-based tools that we can use to meet your retirement goals. However, we have to remind you that insured investments may also lower your long-term expected investment returns. At Oak Harvest, we think our clients are best served by us helping them plan for their future needs instead of focusing on the past. The future and the stock markets are always uncertain, and that's why our retirement planning team plans for your retirement needs first and your greed second. Give us a call to speak to an advisor and let us help you craft a financial plan that meets your retirement goals. Call us here at 877-896-0040 and schedule an advisor consultation. The first one's free. We're here to help you on your financial journey into and through your retirement years. I'm Chris Paris, and from the whole team here at Oak Harvest, Troy, Jessica, James, myself, and everyone else, have a wonderful weekend.